Behaving Wealthy presents the High Worth Shift podcast. Behaving Wealthy. Be, have wealth. Who do you have to be to have wealth? The only difference between rich and broke is worthiness. Your behaviors and your habits are a reflection of your feelings of worth. I'm Robin A. Young, and I'm here to give you enough simple rich behaviors to increase your worth, your wealth, and your freedom. In fact, my promise to you is that every rich behavior I share could yield you 3 times richer results, creating your high worth shift. Welcome back to the High Worth Shift podcast. It's Robin A. Young, certified financial planner and CEO of Behaving Wealthy. And I'm so excited that you've chosen to spend your valuable time with me. Today's episode puts you in the know. In my 23 years of wealth management experience, I've never met, out of tens of thousands of high income earners, a high income earner who acknowledged the distinction between passive income and passive profits. Passive profit beats passive income. High income earners aim for passive income. High wealth individuals know to aim for passive profits. Truth versus hype. Today, I will teach you the truth so that you can reject passive income myths. The 4 passive income myths that are costing you the most are: myth number 1, passive income is easy to create. Myth number 2, passive income is the highest goal to achieve. Myth number 3, passive income means set it and forget it. Myth number 4, passive income happens quickly. These passive income myths are stealing money from your future. Reject passive income myths. Instead, embrace passive profit. What is passive profit? Passive profit is the difference between passive income and passive costs. Passive income minus passive expenses equals passive profit. The most important part of this formula is the passive profit piece, not the passive income. Most high income earners forget to consider the costs necessary to create the passive income. People focus solely on creating passive income without focusing on the costs. It's not how much you earn, but how much you keep. Passive profits represent how much you keep. Not knowing or believing this distinction is costing you freedom now and later. The amount of resources you employ to decrease or streamline the expenses, the more profit you create. The more profit you create, the more freedom you enjoy. Stop wasting your resources. Here's how. The 4th millionaire goal will help you start focusing on profit so that you can afford and achieve your vision of freedom. I call the 4th goal likely wealth. 2 examples of likely wealth are real estate investing and business income. What makes those likely wealth? The overall goal of each is to help you build wealth. In other words, either or both real estate investing and business income's objective is to easily pay for your future goals like college, retirement, and even better lifestyle. Helping you afford more in the future describes the wealth part in the term likely wealth. Now to the likely part of the phrase. Real estate investing and business income are not sure bets. High income earners generally believe that they are. High wealth individuals know there's more to the story. Let me tell you what wealthy people know that others often miss. Real estate investing and business income require you to use considerable resources now for those to become wealth sources. Think about it. When you invest in a real estate property that is not your primary residence, you must pay for the mortgage, utilities, and other upkeep expenses before you acquire consistent and profitable long-term tenants. How are those expenses paid? From your current income. You're exchanging today's current income and what that current income could afford now for more lifestyle in the future. It's a likely wealth source until it can cover all expenses sustainably without using and spending current income. When there's still hope that you will profit later, it is not passive. Real estate property without real estate profits is not passive. It requires you and your current freedom until it turns a consistent and sustainable profit for years. Then it isn't a standalone asset yet. In fact, even if it yields a dependable profit, it's still not ready to be called passive profit. It's still in the active profit phase. Passive profit comes after the surplus works for you, which I'll explain in a moment. Or what if you start a business? Before you have predictable business income, then you're using current money, time, and talent with the assumption that it will be worth it for you in the future. Worth it means giving you more in the future. In fact, enough more that it's worth the sacrifice today. Give up resources now for exponential return later. Since you're working for it and it requires your active participation, I'm sure you would agree that is definitely not passive. Before you have predictable business income, then you're using current money, time, and talent with the assumption that it will be worth it for you in the future. Worth it means giving you more in the future. In fact, enough money that it is worth the sacrifice today, giving up resources now for an exponential return later. Since you're working for it and it requires your active participation, I'm sure you would agree that it is definitely not passive. Ultimately, likely wealth opportunities are spending goals. As I've shared in other podcast episodes, the Millionaire as an Acronym framework that I developed breaks down all your goals into three types. The first goal type describes spending goals, which includes the expenses to maintain your current bills and lifestyle. To be on track with spending millionaire goals, you need a surplus or at least break even every month. Because you use current income to cover expenses, these opportunities must be managed just like you ensure inflows from salaries exceed outflows from bills. This key is often overlooked by high income earners. You must first work for it. You must use the greatest three resources, time, money, and talent, to develop it into an asset that works for you. Critically, you must knowingly accept less now to turn it into a sustainable income and profit producing asset later. Since you must use your greatest three resources, time, money, and talent, it must be worthwhile in the end. If you're in the throes of building a career and raising a family, then these resources are probably already stretched thinly. So efficiency is key. Time management is critical. Money management is critical. Talent management is critical. In essence, you're trading some of your current freedom for future freedom. Your money, time, and talent constitute your current freedom. It must be rewarding enough to give them up now for exponentially more later. Do you know how many times I see high income earners give up their current freedom and not get future freedom? 100% of the time. Well, before they start working with me, of course. I don't want that to be you. It doesn't have to be you. For it not to be you, you must understand this nuanced concept. You must give up the idea of passive income if you're not yet retired. You must embrace passive profits. If you don't, then you could be exchanging current income, time, and talent for less freedom in the future. Now, I believe you understand likely wealth. It may or may not become a wealth source for you. It is up to you to make it into a wealth source. What does it look like to make likely wealth opportunities into actual standalone wealth sources? Likely wealth opportunities need to be profit centers, which eventually pay for your future freedom. Your startup and real estate investments must provide you with a sustainable surplus. The key is to invest the surplus. This next section is absolutely life-changing. The surplus, once expenses are covered and what's left of these sources, is then put to work on your behalf. Then and only then can you look forward to passive profits from compounding. You must invest the surplus and let it grow. This is the real return you want and need. FYI, I created a video version to accompany this compounding example. You will find the link to the video version in today's show notes. Compounding is what you deserve. Compounding works like this. This next hypothetical example will illustrate the magic of compounding. In year one, if you invest $1,000 and it earns 10%, then at the end of the year, you'll have an additional $100, which gives you a total of $1,100. Remember that the $100 of interest is all simple interest. In year one, you will always have only simple interest. Compounding starts in year two. The original 1,000 and the new return of 100 is put back to work for year two. Let's say you earn another 10% in year two. Then your $1,100 will earn $110 of interest, which means your new total at the end of the year is $1,210. Year two's total interest of $110 is made up of $100 of simple interest and $10 of compound interest. Year three's total interest of $121 is made up of $100 of simple interest and $21 of compound interest. Year four's total interest of $133 is made up of $100 of simple interest and $33 of compound interest. Year five's total interest of $146 is made up of $100 of simple interest and $46 of compound interest. You can see the pattern. The largest part of the interest so far is still simple interest. However, that changes in year 9. In year 9, something interesting happens when you break down total interest. That's when compound interest constitutes a bigger portion than simple interest. In year 9, the total interest is $214, which is made up of $100 of simple interest and $114 of compound interest. In year 15, total interest is $380, which is made up of $100 of simple interest and $280 of compound interest. In year 20, total interest is $612, which is made up of $100 of simple interest and $512 of compound interest. Can you see the pattern emerging? Over time, compound interest becomes a much bigger part of total interest. It's just astounding how much money grows with time. For example, in year 25, total interest is $985, which is made up of $100 of simple interest and $885 of compound interest. The lion's share is now compound interest. In year 30, Total interest is $1,586, which is made up of $100 of simple interest and $1,486 of compound interest. After decades of your interest earning interest, more than 90% of the total interest comes from compound interest. This is the magic of compounding. Compounding turns profits into passive profits. This is what could happen to your invested money behind the scenes. This is how your money works for you. This is what your profits need to do to be considered passive profits. You're investing the surplus so that the profits become a great deal more. Now, law of polarity states that for every up, there's a down. So if there's a possibility of wealth, which I explain using the compounding example, there is a possibility for debt. If you believe the passive income myths, then you will likely have money drains. That's what I want to help you avoid. Don't make this common mistake of real estate investing and business income becoming unnecessary money drains. I'll share a case study of a client who was wasting money. Before my client started working with me, he had a $167 per month profit from a real estate investment property, but he was wasting the profit because he didn't have a separate rental property account, which meant that his personal bills and rental property expenses were commingled. He was spending the $167 profit on his everyday expenses instead of maximizing his profit and getting a 300% return on it. He didn't have enough to show for his rental income and his hard work. Then he started working with me. I helped him automate the transfer of that $167 profit every single month. I helped him take the baby step of investing the profit into his retirement account. That one rich behavior of automating that $167 every month will yield him over 300%, which means he is now maximizing his profit. Guess how much that $167 monthly profit will be worth in 23 years for my client? An extra $107,086 for retirement. Would you like an extra $100,000? Of course you would. So follow my suggestion and turn active profit into passive profit. In this example, the $167 is the surplus, which is the active profit, which should be invested. The $107,000 is the passive profit you want because it's working for you while you sleep. This is the passive profit that you want. The compounding part is the passive part. Let's get you to the compounding part so your money is working for you harder than it ever has before. Passive profit beats passive income every single time. Reject passive income as your goal and embrace compounding. Do what rich people do. Wealthy people know this distinction. Every investment opportunity is not worth it for you. This is the key to know whether it is the right exchange of current freedom for future freedom. When you know, you don't think that you are missing out. In other words, no FOMO for you, so you don't waste your current freedom on an opportunity that is not worthy of you. It's important for you to know, and it's time for your high worth shift. Your high worth shift starts with the rich behavior. FYI, all high worth shifts start with rich behaviors. Today's rich behavior is to determine whether your current likely wealth opportunities are worthy of you. Determine the total annual income of each likely wealth opportunity, then determine the total annual cost of each. Additionally, once you have those annual answers, divide those by 12 to calculate the monthly amounts. The reasons you want to know the monthly amount is twofold. Number one, to know whether your likely wealth costs are in conflict with your other goals and obligations, and to know how much current freedom you are exchanging, and to know how much return you need to justify the sacrifice. Now you know exactly how much likely wealth is costing you each year and on average per month. The goal is to know whether you have a shortage or a surplus. Do you have a surplus or do you have a shortage? Is this truth more or less than you expected? Whatever your total amount, annual or monthly, it's not good or bad. Those numbers are simply facts, not to be judged, but to be evaluated based on alignment with freedom. The most important question to ask is this a good exchange for your current freedom for future freedom? The answers from today's rich behavior will help you determine, are you trading now for more or are you trading now for less? You are in control and responsible for creating your freedom. It's critical that you control your resources to experience your highest vision of your ideal life. If you have a profit, then it's time to make sure you utilize compounding to turn it into passive profits. If you're interested in real estate investing or starting a business in the future, then I encourage you to save this podcast episode and please consult with me or another professional to ensure that your plan leads to passive profit. It's worth your time to take your time to find the right profitable opportunity. For now, you can bask in the knowledge that when a person says they have passive income, that doesn't mean they have passive profit. No need for FOMO. You're likely not missing out. Get off the rat race, which comes from focusing on passive income. In this vicious cycle of working so hard for so little, focus on passive profit. The richer results of compounding and not touching it as it grows. You can't have richer results without active profit and time to let it grow. You deserve passive profits. And remember, passive profits beat passive income every single time. Now that you know today's rich behavior, it's time to make your move. Tell us when you complete today's rich behavior and what richer results you experience because you took today's baby step. Text 888-85-WORTH, 888-85-96784. We want to know how you are increasing your worth, your wealth, and your freedom. I know you're worth it, and I want you to know you're worth it. Most importantly, I want you to behave like you're worth it. If you loved what you learned today, please be sure to hit the follow button so you never miss a future episode, and leave a review to help me reach even more listeners just like you looking to maximize and turn their hard-earned income into more. The High Worth Shift podcast is created and copywritten in partnership with Robin A. Young and Behaving Wealthy. Be sure to rate, review, and follow the show on Spotify, Apple Podcasts, Google Podcasts, or wherever you get your podcasts. Especially, be sure to rate, review, and follow the podcast if you really liked it. My promise to you is in every episode to give you one rich behavior that can yield you 3 times richer results. That gives you a 300% return on your time spent with me. Remember, richer results are on the other side of today's rich behavior. You are worth more. It's time to make your move.
Make your move. It's time to focus on yourself. Make your move. Baby, don't mind nobody else. Make your move. Do things that make you happier. Yeah. Make your move. Yeah, you can do it, just relax. Hey, baby, and trust yourself. Good things tend to take some time. Remember, you're the one in charge.